Hello and welcome to the next of our ACCA P7 Advanced Audit and Assurance lecture recaps. This lecture was on outsourcing. So this is when the client that you are auditing outsources some of their functions to another provider. So what are we talking about? We're talking about using a specialist organisation called the service organisation, and they may perform functions for the client such as finance functions, payroll, that sort of thing. Why would they do that? Well, they'll be flexible. They'll be flexible for the client to use. They can adapt to changes if the client maybe has more of something to do one month than the other. The outsourcer can be more flexible in having an internal department. They'll provide the expertise. The client can stick to the knitting, i.e. focus on what they're good at, and it may be cost effective. So these are all reasons why a client may choose to outsource some of their functions. It'll also free up resources for that client. So the pros and cons: on the plus side, they'll get a quality service from the outsourcer. They'll overcome skill shortages within their own firm. There should be less waste. They'll transfer the risk to the outsourcer. They'll avoid non-core activities. It'll be flexible. They'll get the technical knowledge of the outsourcer, and they can change supplier if they're not happy. However, on the downside, the quality may not be there. They need to be very careful that they get a good quality supplier. They may be stuck with that supplier if they've signed a contract. There may be a conflict of interest, i.e. the supplier wants you to keep them on and may actually provide you with a bit worse service than you would expect. The cost will be an issue. So what sort of areas will this actually cover? Well, you've got to consider a few things when you're outsourcing. Firstly, areas of judgment you're less likely to actually outsource, because you'd rather have the people within your firm making those judgments than people within a different firm. If it's a transactional type of function, for example payroll, it's just transactions, it's nothing you have to make a judgment over, then it might be better to outsource that. Also, it's a very specialist area, for example tax, that you don't have the knowledge within the firm. Again, you'll maybe outsource that function. And if it's infrequent, there's no point in having a department to do a certain thing. If it's very infrequent, better to outsource it. So for example, areas that are likely to be outsourced: data processing, it's one of those transactional areas. Pensions, it's one of the expert areas. IT, again an expert area. Internal audit, again an expert area. Due diligence and tax, both expert areas that you're likely to outsource. So the impact on your audit if your client is outsourcing some of these functions: well, when you're planning the audit, you'll have to get confirmation letters from the outsourcer, and you may have to visit that organisation, so you'll have to plan for those things. The scope will be affected. If you've got access denied to some of the information, well then you may have to get you have to consider a limitation of scope, modifying your report. There will also be control risks. You may say that there'd be better controls within the outsourcing organisation, but that may not necessarily be the case. So if there are better controls and you'll have to test them, you may have reduced substantive testing, so it works both ways in that respect. So ISA 402 gives us some guidance on these areas. It says specifically on planning, we've got to look at the materiality of the area. You've then got to consider the controls that the outsourcer has. If it's a significant area, then you've got to understand exactly what function the outsourcer is performing. The access controls that they have, you need to look at the risk. Is there a risk involved? And then you need to look at the contract terms. Now, documenting of the contract terms will be crucial. You need to keep that on file as your evidence, and you need to understand exactly what the terms of that contract are. You need to note: is there access to records? So can you get the information you need? Are there performance standards? What sort of controls do they have, and do they rely on them? And the risks will be, first of all, the inherent risks will be reputation, i.e. the reputation of the outsourcer. Have you looked at it? Have they got a good reputation? Have they got a bad reputation? Supervision, or do you check over the work that's provided to you? Indemnities, are there indemnities in the contract to say, well look, we're not actually responsible for this? Control risks then. Is there controls in place? The extent of the controls that the outsourcer has in place? Are there any errors? Look through the information that's being provided by the outsourcer. If errors are present, well then you may have to reevaluate how much you rely on the information they provide. Does the client monitor the outsourcer, and if so, how do they do that? And do they provide quality assurance? So procedures and evidence when it comes to outsourced information. Remember that all of your evidence must be sufficient and appropriate. So you will have to gather enough evidence and evidence of sufficient quality to support the opinion that you've made on the outsourced firm. If you can't get access to the accounting records, well then you may have to modify your report. So when it comes to reporting, if you can't get the evidence, you may have to modify your audit report. And that was our lecture on outsourcing.